Hello traders, Captain Safa here from Algo Tradingo. In this video, we want to speak about option market. That is one of the most important market in the world, especially in the US. And it has a lot of flexibility on that. And it actually works based on Black-Scholes formula. And it does have something like alpha, beta, gamma, and this kind of things. And it's completely different with a spot market. And it is one of the most profitable market in the world because of the different condition that you can do trade in the option trading. But we want to know the first and important item that makes the option different with any other market. If you work in the future market, as I told you in the previous videos, maybe you can buy wheat for the next 6-month contract with $10 when the price is now $12. And at the final stage or at the maturity, if the price goes lower than 12,000, actually you lost profit and you make loss. And if it goes lower than 10, you completely lose your money in this trade. But if you open a trade in the similar contract in the option, you will face with some different items. For example, if the price is $12 in the spot market, the price for you maybe will be another price more than $10, for example, $11. And in the maturity, if the price goes lower than $11, you can get out of that lost trade without any loss, and you can take your money back and go out from the trade. This is as an insurance for you that if the price goes up in the maturity, you will get profit. And if the price goes lower than what you buy at the first stage, you can get out of the market with no losing money. So it does have somehow insurance in your trades. And for this reason, you have to buy with the higher price in compared to future contract, in compared to the same contract in the future. So it is a completely different market and you have option to take the order or not. Like the futures, if you work with the brokerage, there is no delivery for physical goods or commodity. You will get out of the trade before the maturity time. The broker will get out you from the contract before the maturity time. And this is the biggest difference between future and option market. So you can understand that you have something like guarantee in your initial deposit in this market. And the rules in this market is different, and option market is one of the best market of the world, especially in US because we have US option. The regulation is based on that you can get out of the trade at whatever time that you want. For example, 2 days after starting a trade, you can go out from the position. But we have European option. In this regulation, you cannot go out from the trade before the maturity. And we have different kind of options as well, Asian option, Hawaiian option. You can search on the internet and understand which one is what and what is the regulation in different markets of option. But what I want to let you understand is that binary option is not related to any of this market. Actually, the binary option is a gambling. It works based off gambling formula. And actually you are gambling on something when you work in binary option, and this is not the trading criteria. Do not use of this kind of market that brokerage declare to you. But this kind of option is completely different with different formula, different regulation. The best of them is a US option in all of the world. And the formula and how to work is different from a spot. You have to, if you want to get a long position that is different than a long in the spot market, we call it call. And if you want to go to the short position, the same, somehow same as spot, you have to get a put position, and there are different kind of situation that you can start the trade with a ladder. That's one of the best item. I want to let you understand, because in the spot trade you don't have this kind of items. Let's have a little example about the difference between a spot and option market. Let's consider that this axis is price and this axis is your net profit. If you work on a spot market and you get a long position, you have profit like this. At the first moment of the trade, you have a little loss because of payment of commission and spread and this kind of items. And if the price goes higher, you will make a profit, and at some point you will be at break-even point and you will have no loss and no income. And then if the price goes higher, you will make a profit. And if you, this is for the long position, and if you open a short position, the process will exactly in the reverse manner. And if the price goes high, you will lose money, and if the price goes down, you make a little money. Then you will have break even, and then you will provide some profit there. But let me change the color. In the option market, you have something like this. If it is the price, and if it will be the net profit, and if it be the net profit, you can have the condition like this, that at any stage when you open the trade, you will lose some amount of money. And then if the price goes higher than a specified price, you will make profit. If the price goes lower than a specific price, you will make profit. That is very specific for the option. If the price goes each way, if it goes very high, you will make profit, and if the price goes very low, you will make profit. But in between, you will have loss. So until the maturity, if the price hits these points or these points, you will get profit. So it is really marvelous market, and it's very important to understand this market, and you can have good income in the US option market. That is basically different in compared with the spot.